This is Yulia with the Customer Success Team at Snap Projections. Today, I want to go over what it means when you see numbers in the net cash flow, cash balance columns. We have projections here for Sarah Snapper, who wants to spend $60,000 per year after taxes. When we scroll to the bottom of her projections, we see that some rows are highlighted in pink. What's happening here is that she has a negative cash flow each year, continuing through to the final year of her projections. In other words, she's experiencing a shortfall. Each year, she is short by a specific amount, as shown is in the net cash flow column. These amounts accumulate in the cash balance column, to which we apply a borrowing rate. Essentially, Sarah is taking out a loan to cover her expenses. $3,571 in the first year, $52,246 in the second year. By the end of the second year, with interest on the first year's cash balance, her debt now equals to $55,974. This pattern continues until the end of her projections. Snap automatically creates a simulated loan for her, showing how much she will need to borrow each year to meet her desired expenses, as well as how this debt grows over time at a constant borrowing rate. By reviewing this plan further, we can identify the reason for this shortfall. In the financial assets section, we can see that all of her assets have been depleted. Here's how this looks in the charts as well. On the cash outflow chart for Sarah, the total inflow line drops below her other expenses. On the net worth chart, we can see the gradual accumulation of debt by the end of the projections. Now we can also go to the client report. And under Snapshot's expense summary, shortfalls are shown as red bars, while the purple bars indicate how much the client has available funds to spend. If we examine the cash outflow chart again, which also exists in the client report, we can see that in some years before retirement, our total inflow line actually shows above the outflows. We can also look at it in real dollars. It's more evident that way. So we can see this line going above our expenses. This indicates that the client is in surplus during these years. Let's review this on the planning pages. In the first year, Sarah plans to spend $60,000. She's earning $120,000 in employment income. She's paying taxes and makes some contributions to her financial assets. She also paid a little bit of debt. It turns out that she has a small surplus each year. By default, Snap attempts to save this surplus into available financial assets. First, Snap maximizes RSP contribution room. However, in this projection, the RSP account is protected by an override we set up. We know Sarah does not intend to contribute more than $12,000 to her RSP, regardless of available room. Next, Snap attempts to maximize contributions to TFSA. If there is any room left after that, Snap contributes to any available non-registered assets. In this case, Sarah does not have a non-registered account, So Snap begins utilizing the net cash flow and cash balance columns. The net cash flow column shows how much surplus Sarah has, and this surplus is saved in the cash balance column for future needs. In the next year, there is another $3,191 surplus that goes into this cash account. This balance grows over time to $11,460 in the year 2028. In the next year, Sarah will need to start withdrawing money from this cash balance to support her lifestyle. At this point, the cash balance begins to deplete by that amount in the net cash flow column, $364, until it's fully depleted. This is not a true shortfall because Sarah still has money in her assets, so it's not highlighted in pink. However, as soon as she needs funds, Snap will first use up her cash balance before drawing from her financial assets. You have control over the interest and borrowing rates for this account. In Scenario Setup, Settings, Cash Balance, you can set your own rates. By default, Snap uses the projection assumption guidelines, which are updated annually. Hopefully this clarifies your questions.